Welcome to Hedge Fund Tips with Tom Hayes. I'm Tom Hayes, and this is your VideoCast episode 116, podcast episode 106 for the week ending January 6, 2022. Happy New Year, everyone. So we'll kick it off as we always do with some quick media stuff. Then we'll do a bit of the salient news, and then we're going to get right down to the article of the week. A lot of great stuff to cover between the Fed, between China, between all the exciting things we have to look at and kind of outlook for 2022. So first and foremost, I'd like to thank Ellie Terrett and Jerry Willis, as well as Ash Webster, for having me on Varney and Company. That was my first time on that show on Fox Business. And it was just a simple clip with outlook for 2022. Summary was basically higher volatility and lower returns, and that will be the case for the general indices. But I think under the surface, there's going to be a lot more opportunities to outperform in 2022 as rates rise. The dispersion becomes larger, meaning stocks move less in tandem, and there's a great opportunity for stock pickers to do tremendously well. So that was that. Then I'd like to thank Jack Denton over at Barron's for including me in his article. Was very excited to be in Barron's. That was my first time, and it was just a quote on Outlook. I said 2021 has been a low volatility, high return year for the S&P 500. This is reminiscent of 2013 and 2017. Looking forward to 2022, like 2014 and 2018, we expect volatility to pick up. Tom Hayes, chair of Great Hill Capital, told Barron's, and that was that. So thanks to Jack Denton. Love Barron's, and that's my favorite newspaper is Barron's. My second favorite is the New York Post, and I want to thank Lydia Moynihan for including me in her article. It was about trading by congresspeople and senators. In this case, this particular article was about the Pelosi's, who seemed to do quite well. And it's interesting. So they bought a bunch of long-dated call options on like Salesforce, Roblox, Google, Disney, which I actually agree with. And my quote, I mean, I went through a lot of dialogue with Lydia, but the quote she chose was, they're trying to ride the momentum, Hayes told the Post. The Pelosi's live in San Francisco. They're around a lot of hype, so I'd see how they could get caught up in the euphoria. So I was basically referring to the metaverse euphoria that's out there. But it was interesting because I went through quite a few of the trades that the Pelosi's did over the last 2 years. And I would say that the average retail trader would go a long way to actually take a look at these trades. I think most of them are Paul Pelosi, Nancy's spouse, because he does the exact opposite of what the retail trader does, which is why he wins so frequently. You know, everyone says, oh, do they have special information? And the type of trades that he's putting on are the antithesis of what someone would put on if they had inside information. Meaning, the average retail trader tries to do short-dated trades in the next week or the next month that are way out of the money, very quote-unquote cheap, but have a 90% probability of expiring worthless, and they usually do, and that's why retail traders tend to blow up their accounts over and over and over. Whereas if you look at Paul Pelosi, what he's doing is he's choosing high-quality companies, and he's buying deep in the money so they have intrinsic value. So if the stock is, you know, call it $200, he might be buying a $190 or $180 call option, but he's buying it a year out. He's buying long-dated options where the odds are dramatically in your favor because of trend. Effectively, is what it comes down to, and so you know it's effectively a stock replacement strategy. What he's trying to do is magnify the returns on his bets over a longer period. So rather than paying $200 for the stock, he might be paying $20 for the option. So if the stock goes up 30% over a year, rather than making 30% on that money, he's making 100 or 120%, and he's putting up a lot less money as well. So something to keep in mind, but great article. Thanks again to Lydia Moynihan. Love the New York Post, love Barron's and Fox, of course. And then also want to thank Meta Singh for including me in her article in Reuters. That was on Friday. Love Reuters. Everyone reads Reuters. If you have a terminal, these are the first things you see. And basically the market was doing nothing the last day of the year. Market subdued. It's typical for the market to be down a little bit on this last day of the year, said Thomas Hayes. So thanks to Meta. And then also on January 3rd, I want to thank Bansari Kamdar, Meta Singh, and Shashank Nayar for including me. The value reopening trade was up. I said, looks like the reopening trade is in full force this morning. And it basically says the market is looking through Omicron. It's something we can live with, like the seasonal flu, said Thomas Hayes. So thanks to them. Now, want to go into some of the bad news that came out this week on China. And the reason that I'm loving the bad news on China and China tech is because I said in recent weeks that stocks don't rally on good news. They rally on less bad news. And that's what you're seeing right now. So we saw a lot of bad headlines on China this week, and yet Alibaba is now up about 15% off of its lows. It looks like the bottom is in, and now we're going to press higher. It looks, what is it about? Yeah, so China rolls out new regulation to rein in algorithms used on apps as Beijing continues to clip the wings of big tech firms. So these stocks are now rallying on this type of news. So when it was the first time over the summer, it took the market by storm. All these stocks sold off big. Now the market is conditioned to it, and it's known, and the more specificity, the better it actually is, because now we'll know the rules of the game. And the bigger players, all this is going to do, as I said in previous podcasts, is basically cut out competition. There will be no small or mid-sized firms competing with Alibaba anymore, because it will cost too much to comply, and therefore Alibaba will have a beachhead and control all the business. And that's all regulation ever does, is it makes the big bigger, and that's the name of the game. Same thing happened with Microsoft with the antitrust, etc. So Chinese internet watchdog posts revised app rules to tighten cybersecurity provisions even further. Again, all these stocks are up big time this week. Finally, and that was another thing we pointed to, the turn of the calendar was a big deal. No one could show these on their books at the end of last year, and now they're all saying these are just too cheap to pass up. And then lastly, there was another small fine for a couple of, I think, Baba and Tencent for not disclosing a deal, and it was like $70,000 or something like that. So again, they're rallying because the bad news is in the rearview mirror, and it's less bad news. So and then finally, China is haunted by its one-child policy as it tries to encourage couples to conceive. The reason I bring this up again, and we've talked about this a lot in the past, is because China, while everyone is out saying that China is going to be the new dominant world leader, and certainly their economy has grown quite large, my bet is that they have a higher probability of being the next Japan. And that won't happen overnight, but if you look at the demographics, it's probably a few years off. So what we're seeing with this regulatory crackdown and them effectively crashing their economy in 2021, now they have to reverse course and they have to aggressively stimulate. And we've been seeing that in recent weeks with the reserve requirement ratio. They lowered the main prime rate a bit. They're going to lower the reserve requirement ratio even more. They are injecting liquidity, and now they are cutting taxes because when you punish the biggest employers and the source of growth and the source of national pride like Alibaba, global competitors, you hurt the little person because people start getting laid off. Their outlook for the future dims. They don't want to have children, because why would you want to have children if the greatest opportunity givers are going to be crushed, which is the Alibabas, the Tencents, etc. That's where all the high-paying jobs are. So I would look out on this one. And the other thing that has made America great has been immigration over time. Okay, you need immigration. Well, let me just say, you need population growth to make the capitalist system work. which is the greatest system in the entire world. And, the beauty that we have in America is everyone around the world still wants to come to America. And that's what keeps our population growing, because our birth rate has declined, not as much as Europe, not as much as China, not as much as Japan, thank God, which is why you see the outperformance of our economy and our stock market, etc. But immigration has come down over the last 4 or 5 years. And I think that's a tragedy, because it's going to hurt us economically if that is not reversed immediately. Now, you can argue you want a certain type of person to immigrate, etc. I think you need a plethora of all types of people. You need a ton of people that are hungry and want opportunity and are willing to work hard. And you want some of the educated people that start businesses and that type of thing as well. But we need them all. That's the melting pot, because even the ones that come in that can't speak the language perfectly, that are hungry and work 7 days a week, 16 hours a day, their kids get into our school system and they go on to become the next business owners and the next inventors and the next etc. So that's the one thing, I'm saying China's got some headwinds, 3, 4, 5 years out. Everyone thinks they're going to just dominate everything. And I think that's a low probability, and particularly with the self-inflicted wounds, if they don't reverse those quickly, which I think they are, having that declining population, they may not become the dominant power that everyone thinks, because everyone in the 80s, when the Japanese were buying Rockefeller Center, were buying all these U.S. assets that we were laying off to them at elevated prices, shortly thereafter, because of their demographics, because of their aging population, because of their low birth rate, they went into effectively a depression for 30 years. And they're people think they're coming out of it now, but they still don't have the population. So it's not really going to be a true story. The other thing that Japan never had was, besides the declining population, they have no immigration. Same thing with China, no immigration. So unless they get that birth rate up, the idea of them being the dominant leader, looking 5 and 10 years out is very small, because they don't have the immigration. But the U.S. needs to take a lesson from the Japanese and from the Chinese and get the immigration cranking quickly. High quality, all different types. Just get that thing growing at 2%, plus maybe some incentives. They want to do all the social spending with the Build Back Better, which now looks like it's not going to pass. I would do massive incentives to have new children. That would be my primary thing. You want some type of extra support, have a child in the next 24 months, have 2, and we'll figure out something, whether it's school vouchers or child care vouchers or something like that. But get the population growing. That's going to continue our dominance moving forward, not the alternative that we saw in parts of Asia that have not only declining birth rate, but low immigration. Europe has the declining birth rate, relatively low immigration, although it's better than what's in Asia. But that is a key factor. Moving right along. China tech sell-off deepens as Tencent sales spooks traders. Again, more rallying on bad news. Now, here's some good news. China Premier Li urges bigger tax cuts to ensure economic growth. So they're starting to realize, like we said last year, they were tightening too early while the rest of the world is loosening. Well, they got hurt the most while the rest of the world flourished last year. Well, guess what? The exact opposite is true this year. The rest of the world is tightening, and I'll say that our Fed is acting against too aggressively. They're doing an emotional knee-jerk reaction, which we're going to talk about in the article of the week. But the developed world is tightening, and even Asia's tightening, while China is just starting aggressive loosening. We talked about the reserve requirement ratio, the prime rate, tax cuts, liquidity injections. They're incentivizing. They opened up, I think, another $172 billion of loan facilities for businesses. So I think the opposite's going to happen this year, where the returns in the developed world might be subdued, as they were in China last year, and the returns in China may in fact be the top performer in 2022 and have a record year. So that's what's happening in the intermediate term. A couple of things. Wells Fargo, Bank of America drop price target hikes on bullish loan data. Banks should start 2022 on a good note. This is from JP Morgan Chase analyst Vivek Juneja. On a good note, because of a sharp surge in commercial and industrial loan growth, which we talked about last year, that was part of our thesis. In late Q4, Juneja said in his note to clients, he raised Wells Fargo's price target and also Bank of America's price target. It's interesting, as well as Citigroup's. Everyone's asking me about banks now. So, everyone knows last year, banks was our huge trade. Wells Fargo was our biggest position ever at $25.01 was our basis. And so now that's more than doubled. Everyone's interested. And I would say that's when I start to get less interested. All the people that were on TV when we were building our positions saying this is, DeFi and who needs branches with chains on the pens, etc., is now getting very interested in banks. So they probably have a little bit more to go because the herd is now getting involved. But I would never put new money to work here, and I'll be looking, in the next 10, 20, 30% to be shaving some off for sure with all the euphoria coming in. But I do think they've got a good amount to run. And we haven't even got the major catalyst for Wells Fargo, which is the asset cap being lifted. That'll probably be, sometime in 2022, and probably that last bout of euphoria would be a good place to take a little bit off and bank some profits. Boeing stock rises on new 737 MAX order. This was a big deal. They got an order from Allegiant for 50 737 MAX jets. And Allegiant has never been a customer of theirs. So they took this business from Airbus, which is positive because Airbus had been eating their lunch at the end of last year, winning orders because Boeing was in the penalty box. Boeing also today got another 4 orders for 777 freighters from Atlas Air Worldwide. So that was positive news. But the big thing is they have their plan to get recertification in China. They got to get that completed, hopefully in the next few weeks. And I think that's when it really takes off. First signals emerged that inflation might be near a peak. This is very important considering we're going to be covering a lot about inflation in our article of the week. Data released this week seem to indicate that inflation might be nearing its peak in Western economies. I said that December 15th and 16th, which was the Fed meeting when they were all panicking, as you saw now in the minutes this week about inflation, I said that panic would probably be the peak of all the inflation reads, meaning they wouldn't get any higher than the levels we saw when they were panicking and aggressively speeding up the taper, which they didn't need to do, talking about rate hikes in March, which they didn't need to do, and we'll get into that. But so the Institute for Supply Management's Composite Index, a key U.S. business survey, stood at 58.7 in December, falling short of expectations, but showing a continued expansion for U.S. factories. The data also showed that manufacturers' input prices and supplier delivery delays declined month on month. That was the biggest monthly drop in the prices paid measure in over a decade and leaves it at its lowest level since November 2020, Deutsche Bank analyst wrote. So just to repeat that, the biggest monthly drop in prices paid measure in over a decade and leaves it at its lowest level since November 2020. That was in the Deutsche Bank note. So these supply chain things are easing up. We were ahead of the curve on this one. And hopefully the Fed won't do too much damage before the data shows that they're moving too fast and they can slow down and put their foot on the brakes before it's too late. Dogs of the Dow, the reason I bring this up, this hasn't worked in the last few years, but over time it does outperform the general indices. And what it basically means, if you buy kind of the 10 worst performers, i.e. the highest yielding stocks in the Dow at the end of the year, over a long period of time, not the last few years, you tend to outperform the indices consistently. And this year, the worst performers were Dow Inc. That has almost a 5% yield. IBM, almost a 5% yield. Verizon, almost a 5% yield. Chevron, a 4.5% yield. Merck, a 3.6% yield. Walgreens Boots Alliance, 3.5% yield. They just reported they're crushing it. We've held that for a while from $42. It didn't do a lot. It's up to $55, but now it seems to be finally moving. Amgen, 3.5% yield. 3M, I think this one's interesting, 3.3%. Coca-Cola, 2.8%. And Intel, we own from lower. And this one started to take off in the last week as well, 2.7%. So I think, this is a good basket to look for a few high-quality companies. Few quotes of the day I want to cover for this week. First off, Buffett. At age 19, I read a book, The Intelligent Investor, and what I'm doing today at age 76, now 92, is running things through the same thought process I learned from the book I read at 19. It's interesting because, a lot of interesting people follow this from, institutions to hedge fund managers to journalists to very, ultra high net worth investors, to younger college kids to personal investors, all across the gamut. And a lot of the times the younger kids will reach out to me. They're either in college or in their 20s, and they'll ask me some questions, etc. And I love going into the questions, helping them in any way I can. And I always give kind of the same advice. Read The Intelligent Investor, read every annual letter that Buffett's ever written, even the ones from his partnership. Learn a new company a day with Value Line, the ones that interest you, read the annual reports, etc. And I go into some basic advice, and then invariably they'll reach out, 2 weeks later or 3 weeks later or 3 months later and ask for an internship or something. And I say, how's your reading coming? And they're like, what do you mean? I said, what did you learn from The Intelligent Investor? And invariably, in most of the cases, there are some exceptions. There's one young man in Canada that did a lot of reading and learned a lot from the letters, and he's on his way. But, there's no quick fix. The old saying, only the game can teach you the game. And I shared, the first hedge fund I worked at, the principal, who was very successful, he didn't, teach me hands-on. Like, I didn't sit next to his desk. He gave me, like, a list of books to read, said, read all the CFA books. He pointed me in the right direction, but I had to have the initiative. I had to do it. I brought him ideas, and we'd walk through it, et cetera, et cetera, et cetera. So I guess the point is, Buffett's a master. Learn that as your basis. Do the work. You got to put in the work. And by the way, if you're resisting doing the reading, this is the worst possible business you could ever go into. This business, probably your net worth in this business is highly correlated to the amount of pages you read. So if you don't like reading and you don't like learning and you just want a quick fix where you can look at a couple squiggly lines on charts, have at it. But good luck in building wealth. Wealth comes from, study, experience, and thoughtful analysis over time, and it compounds, and that's how you really win. And then the other people, I get a bunch of people, I want to start a fund or start a hedge fund. Candidly, and I think it was Munger who said it best. I never took a penny of outside money until I didn't need any money. And I think that should be the rule of thumb. After you've built your own net worth to a point where you can live off your own money, then at that point you've proven to yourself that you've developed the skills to develop wealth not only for yourself but for the people whose money you accept. And I think that's a good way to go about it. Is invest in your learning, invest your own money, earn working for someone else. Compound that money, and when you've proven to yourself that you can build wealth and live off the wealth that you've built, then any outside money that comes is just a bonus, and that's how you really grow, and you'll grow by word of mouth and build a nice business that way. So, but you got to put in the work, and I thought I'd just want to emphasize that quote. The second quote, which is great, came from Charlie Munger, and it's really appropriate this week. He says, wise ones bet heavily when the world offers them that opportunity. They bet big when they have the odds, and the rest of the time they don't. It's just that simple. So Buffett's been making some serious bets. He hasn't made a major bet in years. He's always owned Wells Fargo. He's always owned Bank of America through thick and thin. And he started buying Alibaba in the first quarter of last year. Then he bought some more the second quarter. He doubled down in the third quarter. And we just found out on Tuesday that he doubled down on his double down in the fourth quarter. So he's now probably brought his basis down I would say into the 160s with that kind of bet in the fourth quarter. He'll at least double his money over the next few years and probably a lot more because he tends to hold things forever. So you couldn't buy the business at a better price and at a better time. So kudos to Charlie Munger for living by his word. Bill Gross, legendary bond king manager, now retired. He said the market can move for irrational reasons, and you have to be prepared for that. You need to make big bets when the odds are in your favor, not big enough to ruin you, which we've covered a lot in the last couple of weeks, but big enough to make a difference. And for some people, Buffett was talking about for his own personal money, he would go as high as 75% sometimes in ideas that he felt couldn't lose. Our max has of highest conviction of all time positions has never been more than 20%. But if you structure those right with a combination of stock and derivatives, the notional can be much, much larger, and you can get the effect of having that type of exposure without having the risk. And that's what we've done with BABA. So we're excited about that. Here's the article from Barron's. Charlie Munger's firm doubles down on the Alibaba investment again. So the double down on the double down. And now let's go into the questions of the week, the Ask Me Anything questions. If you guys have any, you can go to hedgefundtips.com, just hit the contact button, or you can email info@hedgefundtips.com and send them there. So Josh Horton asks, I've been a listener of your podcast for over a year now, and I wanted to thank you for the outlook you share with us. I've learned a lot listening to your podcast. I've been following Alibaba, and I was curious, what are your thoughts on AT&T? So this is an interesting one. AT&T's basically been doing nothing for years. Let me just pull up the chart here. So this is a 20-year monthly chart, and it's effectively gone nowhere since 2012. So for about 11 years, and it does look like now it's wanting to take off. Let's take a look at the business. So it's trading at 7.5 times earnings. Its average PE over the last 15 years has been 13. And the reason it's done nothing is because the business has done nothing. So, cash flow per share has hovered right around $6 or $7 a share over that 10-year period. It's not really growing yet. The revenues have basically flatlined for the last 5 years. They are paying down some debt. The return on capital has been about 8% a year. So, but they've had a big dividend payout ratio. So right now the dividend yield is about 9%, or 8%. That's going to change. They are doing, let's see. So the big issue is AT&T has always been a stock for dividend investors, okay? And they're spinning off Warner Media, the entertainment empire they acquired in 2018. AT&T shareholders will keep a 71% stake. This is from the Wall Street Journal, stake in the new media creation. So the company's stock price partly reflects how the market values that future media business, which will be called Warner Brothers Disney. And now, the telecom company remains expected to pay shareholders a lower annual dividend. So basically, they're going to cut that dividend by a third, which is going to take it down to 5%. This has been a company that has been known to increase dividend over time. So this is like a really bad situation. And the type of people that invest in this type of company are not happy, which is why the stock has been under so much pressure in the last year. The payout's going to drop from $15 billion to between $8 and $9 billion. So even more than a third, as much as a half. That would take the dividend down to 4%. So you've got all those sellers out. All the dividend investors have been dumping their stock. My guess is this stock really starts to rip higher the minute they announce the dividend cut. If you remember, that was part of our thesis for Wells Fargo last year. Once the bad news is out, the stock ripped higher. And I think it's going to be the same for AT&T. It's starting to move. They also reported that it's been up in the last couple of days. The stock rises after posting 1.3 million subscriber ads. So their fundamental business, which they're now going to be focused on, looks to be doing okay. This thing seems oversold. I think that the catalyst is going to be when they announce that dividend cut. Maybe you'll get a sell-off for a day, and then it'll start to rally. So generally, look, A business can't grow faster or slower over time than its return on capital. So this is a business that has a consistent 8.5% return on capital, which means maybe there's some pent up reversion in the stock since it hasn't moved in the last decade basically, but neither has the cash flow nor the business nor the revenues. So there's no real catch up. The only thing would be once they get out of the non-core businesses and invest in their core business, that maybe their return on capital goes up, in which case, so, looking at this simply, I think this could certainly shoot back up to $35, maybe $40, but I just don't see a catalyst for it to go much higher. Now, from $25 or wherever it is today, that's a big move. So I think you've got a margin of safety. You're not going to get hurt too much to the downside. You'll probably get a shoot up to the upside, mid-30s, when they cut the dividend. But we need to see something that's going to increase their return on capital. That said, let's say they drop the non-core business and they actually start to grow the business at 8% a year. You got a business that's basically going to double every 8 or 9 years. So decade out, rather than the stock sitting at $30, it could be at $60. And in the meantime, the dividend's grown from whatever it's going to be now, 4 or 5%. To what will effectively be 10+% on your cost. So it's not a horrible investment. It's better than a bond. So in terms of your safe bucket, it might be worth a look. I want to thank Don Gaffney. Sent a nice little testimonial. He goes, I'll read Tom's work like an economist parses a Fed chairman's meeting, going over it with a fine-tooth comb. He's one of my favorite financial gurus. Side notes, congratulations on your 2 guppies, the daughter swimming. Well, thank you for that, Don. I appreciate it, and appreciate you being with us for some time now. So very happy for that. Next question. Hi, Tom. Thanks for sharing your superb insights and analysis with us throughout 2021. I have an Ask Me Anything question for you. I own Boeing, Lockheed, Raytheon, as well as Aerospace Defense Sector, ETF XAR, and believe these will come up at least 15 to 20% from their present levels in 2022. I agree with that. How strong do you think the secular trend is over the next 2 to 3 years in the aerospace and defense sectors? And do you think if these stocks do run up 20% in 2022, that would be prudent to hold them rather than trim them? Wishing you and your family spectacular 2022. Alan A. So, Alan, this is a great question. I think the secular trend is extremely strong, and I think that some of these stocks like Boeing are going to be up more than 50%, 75%. The same thing with Lockheed Martin. So, what I would do is after they're all up 20, 30%, send me another Ask Me Anything question on an individual name. I'll take a look at it and tell you my thoughts. But I think these things are going to move for 2, 3+ years. And I think they're going to move a lot more than 15 to 20%. Ben First Name Only asks, is IYR due for a correction? How deep? Second, latest thoughts on XOP and XLF. So that's so he's asking about REITs, energy, and financials. Do you expect another shakeout of late money into oil, XOP, XLE, and how much of a shakeout? Thank you, Ben. All right, so let's take a look at these. So I pulled these up. This is the, so we'll take them one by one. 3 sectors he's asking about. This is the number of real estate stocks, i.e. REITs, above their 20-day exponential moving average. And as you can see, they rallied up to 100 and now they're rolling over. So in the very short term, I don't love the REITs, and I said as much. You asked the question a few times in the last few months, and I said, for me, the risk reward is not attractive here. I wouldn't put new money to work, and they're starting to roll over. I think they'll probably be weak for a little bit longer. In the short term, rates are perceived to be rising. this is not where I'd put money after this type of move. I mean, down here it was interesting last year when no one wanted it. Any of the REITs up here when everyone wants them, I'm less interested. If I own them, would I keep holding them? I mean, maybe. I'm just not crazy about it. I'll just show you another example here. This is bullish percent on the real estate real estate sector. This, so bullish percent, that's a point and figure trigger. I don't use point and figure charting, but I do find this measure pretty useful as a barometer for sectors. And it got up to 96. Again, the risk reward is not in your favor. Could it push back up to 100? Of course it can. Can it make new highs? Of course it can. And can it stay elevated for a few more months? Of course it can. It did that in August through June of last year. And it may very well do that. But I don't like the risk, not for new money. If I held it, things I hold, I just hold. So and not loving it here. And it's not my favorite. There are too many other things to do where I have a margin of safety and I can double my money. Why am I going to, jump in front of a steamroller to pick up nickels? No interest. Okay, second question was energy. This is the percent of energy stocks in the S&P 500 above the 20-day EMA. It's at 100%. Now, that doesn't mean anything because it can stay at 100% for a while. But again, the risk reward, you're rewarded more when you're buying when it's at 0%. That's when you get paid. When it's down here and you're buying, you tend to do better than when it's up here. That's not to say it can't break out and push higher. And actually, if we look at the bullish percent energy, it does look like it has a little room. It's at 95, not 100. But again, I want to be buying when it's down at 10, when it's down at 7, when it's down at 3, when it's down at 3. That's where you make your money. So again, you're picking up nickels. Can some of these stocks move another 10 or 20% in the short term? Yes. Over the next 1 to 3 years, do I think that the whole group, the servicers is where the real value is. They haven't even moved some of the servicers. Like the National Oil Well Varcos, even Schlumberger to a lesser extent. Those guys have not even started yet because the rig count has been subdued. I think that rig count will go up over the next few years. As a matter of fact, Europe, I guess, didn't like paying $10 for natural gas, so now they're going to say natural gas is green because they don't like freezing. So they're going to do natural gas and they're going to do nuclear, which is fantastic. Nuclear is going to be a big part of the green thing because renewables aren't enough on their own. And that's a very constructive thing moving forward. So, and industrials will be a beneficiary of that, by the way. So, energy, yeah, I think it's got a little more juice in the short term. But again, where are your odds the highest when you're buying down here? So we're more looking, when we look at groups like this, we're looking, over the next 10, 20, 30% to be shaving off and taking profits versus getting more aggressive up at these levels. And then over the intermediate term, 1 to 3 years, we like them. Secularly, we like them. We like energy. We think it's going to do well, but I think he's asking more of a short-term question. And then financials of the three seem to be in the best shape, like they can push higher in the short term. Here it's at 75, so maybe it pushes up to 100 on the 20 EMA. And then on the bullish percent, it's only at 75. So this technically has some room to run. And that would make sense because the yield curve stopped flattening this week. It hasn't started re-steepening yet, but it stopped flattening. So that's a move in the right direction. Okay, the article of the week is the I Dare You stock market and sentiment results. So as I get older, I listen less to what people say and simply watch what they do. On Wednesday, the market was down pretty big, particularly tech, as a reaction to what was said in the Fed minutes from the December meeting. The key surprise was the idea that they would consider running off the balance sheet potentially right after the first rate hike, which could be as early as March. The last time they engaged in quantitative tightening was 2018, which inverted the yield curve in about a year and a half, and you had a recession 6 months later. So while the 2-year Treasury, 10-year Treasury ratio, 2-10 spread, what it's colloquially referred to, stopped racing towards 1 this week, also known as an inversion. So you see that white, it's starting to tick back up. I think it would be aggressive for the Fed to, number one, implement 3 rate hikes in 2022, which the market is now pricing in. This is the Fed funds futures for the December meeting is showing that the largest part of people think that the Fed funds will be between 75 to 100 basis points. 2, start the balance sheet runoff as early as March. That would be a disaster. There's no reason to do that. So to put it in perspective, on December 18th, 2013, the Federal Reserve Open Market Committee announced that they would be tapering back on QE3 at a rate of $10 billion each meeting. The taper was completed by October 2014. So they started the taper here. And remember, in most tapers, they're still buying during that taper period because they're just reducing the amount that they're buying, which is still happening right now. That's why the balance sheet's still going up, but that will stop in March because they've accelerated it. So it took them 11 months to wind down. In our case, they started in November. They're going to be done by March. That's only 5 months. I think it's too fast given what we're seeing inflation already rolling over in some parts, which we covered earlier and in previous weeks with certain commodities. So they took 11 months. Then they waited another 15 months after the taper was completed before they started hiking rates. So taper begins, taper ends in October. They wait another 15 months until December 2015. So they announced taper December 2013. The first rate hike doesn't come until December 2015. So 2 years. They announced taper in November, which would mean that the first rate hike wouldn't come until November of 2023 if they went along a more reasonable path. But they're emotionally panicking rather than being more considered so far. We'll see what they actually do versus what they say, but we'll see. So it took approximately 1.5 years after they began the balance sheet runoff before inverting the yield curve, and another 6 months later we were in a recession. So here's when they started quantitative tightening or running off the balance sheet, as they're proposing to start as early as March, which is crazy. Literally during this period, took them 15 months. Let's see. Yeah, it took them a little over a year and a half. They inverted the curve, and then 6 months right after we had a recession. And that every time you invert the curve, within 6 to 18 months, you get a recession, pretty much guaranteed throughout history. The only explanation for accelerating the taper, 5 months this time versus 11 months last time, accelerating rate hikes, expected 0 to 3 months after taper this time as early as March versus 15 months after taper last time. And thirdly, the balance sheet runoff / quantitative tightening right after the first rate hike this time versus 2 years after the first rate hike last time is a complete emotional knee-jerk panic at backward-looking inflation data, which was largely caused by supply chain bottlenecks. That's not to say we won't run above trend inflation. If you look at 5-year break-evens, it's at 269 down from 319. That's above trend. 2% is trend. So I do think we're going to run above trend for the next 3 to 5 years, maybe 2.5%, maybe 3%, and I think that will be positive. It's not going to be off the charts inflation or hyperinflation or anything of that sort. It's going to be above trend, which is good for business. It gets people investing now, gets people acting now, buying things now, because they can't just sit around forever like they did in the last 2 decades of deflation where there was no incentive to move quickly. Moving quickly is a good thing, and it usually leads to higher GDP growth. So that's a positive. Okay, so that is literally the only plausible explanation for talk about completely taking the punch bowl away all at once, and I will add completely irresponsibly if they do it. So if they follow through with anything like what has been proposed in the Fed minutes yesterday from December, 3 hikes in 2022 coupled with balance sheet runoff, they will invert the yield curve within 12 months and will have a recession within 24 months guaranteed. This likely guarantees a political change in the executive branch in 2024, which is very aggressive for a group that is supposed to be apolitical. So half of you listening are going to be very excited about that. Half of you listening would not be excited about Fed playing politics. Presidents don't get reelected in the middle of a recession. Just ask Bush Sr., Carter, and Trump. The question is, will they do what they're talking about? Their talk wasn't cheap on the accelerated taper. That was a surprise and completely unnecessary. Chair Powell did an about-face within days of his reappointment. Now we have to wait and see if they are seasoned pros who will be thoughtful, patient, and data-dependent moving forward, or emotionally react to short-term spikes in data and headline noise. Here's the key text from the December Fed minutes. So participants generally emphasized that, as in previous normalization episode and as expressed in the committee statement on longer run goals and monetary policy strategy, changes in the target range for the federal funds rate should be the committee's primary means for adjusting the stance on monetary policy in support of its maximum employment and price stability objectives. Agree with that. They should be using rates before any balance sheet runoff. This preference reflected the view that there is less certainty about the effects of changes in the federal funds rate on the economy than about the effects of changes in the Federal Reserve's balance sheet. That's correct. They should live by that. But you'll see as it goes on, it gets worse because they start pushing for balance sheet reduction right away. Moreover, participants stated that the Fed funds rate is a more familiar tool to the general public and therefore is advantageous for communication purposes. A few participants also noted that when Fed funds rate is away from their effective lower bound, the committee could more nimbly change interest rate policy than balance sheet policy in response to economic conditions. Participants also discussed some key differences between the current economic conditions and those that prevailed during the previous episode, and remarked that the committee would have to take these differences into account in removing policy accommodation. Most notably, participants remarked that the current economic outlook was much stronger, with higher inflation and a tighter labor market than at the beginning of the previous normalization episode. They also observed that the Federal Reserve's balance sheet was much larger, both in dollar terms and relative to nominal gross GDP, than it was at the end of the third large-scale asset purchase program in late 2014. Participants noted that the current weighted average maturity of the Federal Reserve Treasury holdings was shorter than at the beginning of the previous normalization episode. Some observed that, as a result, depending on the size of any caps put on the pace of runoff, the balance sheet could potentially shrink faster than the last time if the committee followed its previous approach to phasing out the reinvestment of maturing Treasury securities and principal payments on agency MBS. However, several participants raised concerns about the vulnerability in the Treasury market and how those vulnerabilities could affect the appropriate pace of balance sheet normalization. So there are a few people thinking on the committee. That's a good thing. A couple of participants noted that the SRF could help to mitigate such concerns. Participants also judged the Federal Reserve to be better positioned for normalization than in the past, as the ample reserves framework and the Federal Reserve's current interest rate control tools, including interest on reserve balance and the overnight reverse repurchase agreement on RRP facility, are in place and working well. Some participants judged that a significant amount of balance sheet shrinkage could be appropriate over the normalization process, especially in light of abundant liquidity in money markets and elevated usage of the on RRP facility. That abundant liquidity is abundant until it goes away, and we saw that in the great financial crisis. So they should act in a measured way over time, not this rush, accelerate everything, do it all at once and see what happens. And that's what the language here is implying, and that's why the market got spooked yesterday. Now, participants had an initial discussion about the appropriate conditions and timing for starting balance sheet runoff relative to raising the federal funds rate from the ELB, the effective lower bound. They also discussed how this relative timing might differ from the previous experience, in which the balance sheet runoff commenced almost 2 years after the policy rate liftoff, when the normalization of the Fed funds rate was judged to be well underway. Almost all participants agreed that it would likely be appropriate to initiate balance sheet runoff at some point after the first increase in the target range for the federal funds rate. This is what scared the hell out of the market, and justifiably so. Like, wait a year, see how the market deals with rate hikes and the taper before you start quantitative tightening and actually literally sucking liquidity out. Never mind stopping to increase liquidity, but sucking liquidity out. However, participants judged that the appropriate timing of the balance sheet runoff would likely be closer to that of policy rate liftoff than in the committee's previous experience. That's not good. They noted that current conditions included a stronger economic outlook, higher inflation, and a larger balance sheet. So they're responding to the peak inflation readings that came in coincident with the December 15th and 16th meeting, and they're all emotionally reacting like a bunch of retail traders on a one of those discus boards or whatever they call Discord chat rooms. They should join a day trading community so they can respond to all the emotional squiggles in the market and short-term headlines rather than thinking in a professional, tempered, longer-term view and not doing it all at once before you know the impact of one thing. Okay, they noted that the current condition, so and could warrant a potentially faster pace of policy rate normalization. So now they want to not only start the quantitative tightening 2 years faster than they did last time, they want to increase the speed of rate hikes. They emphasize that the decision to initiate runoff would be data dependent. God help us. Let's hope that's true. Some participants commented that removing policy accommodation by relying more on balance sheet reduction and less on increases in the policy rate could help limit yield curve flattening during policy normalization. Now, that's important. At least they have their eye on the flattening yield curve because that guarantees a recession. So if they think they can finesse this balance sheet runoff to keep the yield curve steep while they're doing it, which I doubt they can, but let's assume they can. It's never been done. It would be an experiment. That would be the best of all possible worlds, a Goldilocks scenario, but I don't think that's going to be the case. The last line is especially important. These are my words now. It indicates that they are cognizant about the implications of a flattening yield curve. The implication is that if they move forward with balance sheet runoff after the first rate hike, perhaps they will be less aggressive on the pace of subsequent hikes, although that was not evident in their verbalization above, which I just read to you, as they are draining liquidity with the balance sheet runoff. That would potentially meet their goal of keeping the yield curve steep while cooling a hot economy at the same time. It would be an innovative but untested approach. The more likely outcome is that by the time they meet to discuss the second hike, inflation will have moderated, still above trend, but declining rate of change, and perhaps they will moderate their hiking pace in line with the new data. That would be the best case scenario, and that will be the ideal soft landing. The most important thing to keep, meaning rather than 3 hikes in 2022, maybe one to two, would be more consistent if we're correct about inflation moderating sometime after March. The most important thing to keep in mind is that these minutes were likely coincident with peak readings across all inflation measures. Time will tell, but when you look back, it will likely be clear that this panicked rhetoric you see above was a short-term overreaction. Okay, outlook. On Friday, so we covered that. Thanks again to Jack Denton at Barron's and Ellie over at Fox Business, Ellie Terrett. Value. Value is trying to climb back into pole position as it did in Q1 of 2021. The Q1 move in 2021, despite lack of follow-through for the remainder of the year, was enough to make energy the top-performing sector in 2021, as well as financials was in the top 3 as well. We're seeing kind of a repeat of this once again, which would be very, very constructive. This was the value to growth move, and it's starting to pick back up again. We saw it the first few days of the year. Financials dramatically outperforming tech. You see this table here. And we have the ascent and breakout of the 10-year yield to thank for this early rotation. We've consistently said value, small caps, cyclicals outperform with a steepening rising rate environment. We'll see if we get follow-through in coming weeks. So we did get some follow-through today on the 10-year yield. So it barely broke out yesterday, and I think it pushed through to 173. So it's a real breakout so far. For those of you who have followed my VideoCast for some time, you know our base case was 2 to 2.25% on the 10-year yield for Q1 2022. However, we also pointed to the last cycle when the 10-year yield peaked counterintuitively when they announced taper and started coming down. Yields started coming down as they were slowly pulling out as a buyer, i.e. new demand showed up at that point. So last time they announced the taper here, it tried to break out and then it rolled over. So, we'll see if this is going to be another one of these cases where it peaks. I think at 2%, 2 to 2.5%, you want to start buying all the bonds you can. I think that's going to be the peak for this cycle on the 10-year yield. Maximum 2.5, but so we've got some room, and in the interim, energy, financials, cyclicals, industrials can all really do incredibly well. So we'll watch that. Let's see if this breakout is real. And that was that. Follow through in this breakout would favor a continuation of the nascent 2022 value trend. A breakdown would bring back a bid into beaten down tech. We favor value. Now, the rotation, the last shall be first. I put together a couple tables here, one from Novell Investor and one from JP Morgan. And they are an asset class performance by year and sector performance by year. And I think you're going to find this really, really helpful. As we look at both the sector rotation chart and asset class rotation charts, we find one common denominator. It is unusual for a sector or asset class to lead 2 years in a row. As such, we like to look for laggards to put new money to work. This year, we're focused on industrials for the sector and emerging markets. China is the biggest weight in emerging markets for asset class. Most of our new ads have been in these two groups in recent weeks. That does not mean we drop everything else. It simply means we lean into where there's value and don't chase what has already made the biggest part of its move. Now, key point for those of you listening to the podcast and not on the VideoCast. This is going to cut off in 3 minutes at the 60-minute mark. To get the rest of it, because we're going to start going into the China stuff in just a minute, just go to hedgefundtips.com. You'll see the first, second, or third post is the VideoCast. It's a YouTube video. Fast forward that video to minute 60, and you'll pick up word for word exactly where you left off. And then later, if you miss some of these charts, you want to see the visuals, you can just rewind it back and see everything that you heard but didn't get a chance to see. So let's just take a look at 2007. Real estate was about the worst. And then in 2008, it picked up a little bit. 2009, it was towards the top. 2010, it was the best performing sector. Then it started to roll off. 2011, 2012, it was the worst performing sector in 2013. So if you just follow this line, it moves in these trends. Then it went from worst to first from 2013 to 2014. Then it dropped off it was back to worst in 2016. Back up in 2018. Then it rolled back over. Then it was the top in 2021. So it just zigzags. The last shall be first, the last shall be first, the last shall be first. And the market continues to move because these sectors keep stepping up. The exception was energy was weak from 2014 to 2020. That's commodity based. That's a different cycle. And then it was the top performer last year, up 54.6%. Financials were the third worst in 2020. They were the third best in 2021. Let's do one more here. How about, let's take healthcare, okay? In 2008, it was the second best. Then it moved down to the middle. Then it was the last in 2010. Moved back up to the third best in 2011. Then it started falling. Then it hovered in the top. Then it went to the worst in 2016. By 2018, it was the best again. Then almost the worst again in 2019. Middle of the pack the last 2 years. So that. It just shows you. So people extrapolate what happened in the recent past is going to continue, and that's usually the opposite of what happens. So for this year, what we'd be looking at, what was the worst? Utilities. Industrials was the third worst. That's one of our biggest new ads. We're adding a lot of industrials between Boeing, Lockheed, a number of others. We like this group a lot for next year. Some healthcare. Cigna's already had a pretty big move. That probably needs to rest for a little bit before moving back up towards 270. And then financial and energy, they'll probably do just fine next year. And don't forget, in these rotations, they're usually positive. They're just less positive. Energy's not going to be up 54% in 2022. Financials aren't going to be up 35%. They'll probably be somewhere in the middle of the pack. And then, 2 years out, maybe they'll be on the lower of the pack, like you see the normal rotation. So that's why industrials is our top pick. Next is asset class. So, if you look at emerging market equities, I love this. It was the best in 2007, the worst in 2008, the best in 2009, the worst by 2010. Back up to the top in 2012, back down to the bottom in 2013, stayed down there. Number one performer in 2017, worst performer in 2018. Back to the top in 2020, worst performer last year, and I think this is going to be back up to the top next year, which is why that's our top asset class with particular weight on China. So, moving on to China. Charlie Munger doubles down on his double down. My favorite movie of all time is Swingers, starring Vince Vaughn and Jon Favreau. I rarely watch any movie more than once. I probably watched this movie 36 times in my 20s. And unlike Mikey, Jon Favreau's character, you can watch the video here where he's in Vegas and Vince Vaughn tells him to double down because he was dealt... I guess he was dealt an 11. He was dealt an 11, and Mikey goes double down. I'm sorry, Vince Vaughn goes double down. Trent is Vince Vaughn's character's name. Trent goes double down, and Mikey goes, it's my last $100. I can't do it. He goes, you got to double down on 11. Everyone's like, you got to double down on 11. Sure enough, he gets 18. The dealer gets 21, and he loses. And the moral of that story is not that he took the wrong bet. The moral of the story was he had no edge. Number one, and number two, he had no bankroll to play the odds over a series of time. He got stopped out both on bankroll and on time. Stocks, on the other hand, give you all the time you need when the odds fundamentals support a reversion to intrinsic value. We covered this in depth in last week's note. Last week's note was very, very important analysis comparing Alibaba to Microsoft in 2013. So you can click here to review that article. But let's go here. So unlike Mikey, Jon Favreau's character, Charlie recently took the right bet to double down on his already doubled down on his Alibaba position when the odds favor him. And here is the filing from Tuesday. So you can see he started buying in Q1 of last year. And then he basically doubled it in Q3 as the price came down. And then he doubled down, so he had like about 300,000 shares from both of the Q1 and Q3 purchases. He just bought another 300,000 shares, and that's probably got his basis down to 160, and that's why he's going to double his money over the next couple of years for sure, and then probably a lot more over the long term because he tends to hold things forever. And these are the odds. I would go through last week's article in detail. I don't want to rehash that, but you can just see a visual of their revenue in white and net income. You're paying for the same price as 2014 down here when it IPO'd, and you're getting all of this, and it's going to continue to grow. Top line will grow not at 30% anymore. It'll grow at 20%. So 5 years out, you'll have this, and you paid for this, which is a good thing. This is the same with operating cash flow, which is the key measure. And free cash flow just continues to go up and up and up. That's a sign of a healthy business. Estimates moving forward, you can see up and up and up out to 2024, and earnings up and up and up. Now, one of the factors that I didn't mention in last week's article, podcast VideoCast, is return on capital. What Charlie fails to mention in the image quote below is the inverse, which I have stated here. So let me just read his quote first. So Charlie Munger says, over the long term, it's hard for a stock to earn a much better return than the business which underlies it earns. So over the long term, it's hard for a stock to earn a much better return than the business which underlies it earns. If the business earns 6% on capital over 40 years and you hold it for that 40 years, you're not going to make much different than 6% return, even if you originally buy it at a huge discount. Conversely, if a business earns 18% on capital over 20 or 30 years, even if you pay an expensive looking price, you will end up with a fine result. Now, what is the inverse of this? The inverse is it's hard for a stock to earn a much worse return than the business which underlies it earns on capital over time. Let me repeat that. It's hard for a stock to earn much worse return than the business which underlies it earns on capital over time. Looking at the data below, you'll see the average return on invested capital for Alibaba since inception is 18%. If you compound 18% return on capital from its 2014 IPO opening price of $92.70, it gets you to $295 intrinsic value over 7 years. On the US ADS price, equivalent percentage gains on Hong Kong 9988 or the placeholder BABAF. This is not reflected in the current price, which was about $120 yesterday. It's $127 today. But like holding a ball underwater, eventually it will erupt back to its level. So what I'm saying is the business has compounded 18% over the last 7 years. The intrinsic value should be just under $300. This excludes the continued compounding that will accrue in the interim as it gets to $295 and the forward growth expectations and multiple expansion, which we covered in detail last week as it related to Microsoft and how the same thing will happen to Alibaba. The multiple expansion that occurs when sentiment inevitably changes. Okay, we saw it in Wells Fargo. We saw it in banks and energy over the last 15 months. We're going to now see it in Chinese stocks. The last shall be first. So this is of critical importance. And I went into some longer term outlook targets on the VideoCast last week. So, the current intrinsic value for this business, in my view, is just shy of 300, somewhere between 260 and 300. And it'll work its way up there over the next few years, in our opinion. This is opinion, not advice. Go to hedgefundtips.com, click on terms. But I think that looking out, not only are you going to get that reversion back to its current intrinsic value, but you're going to get multiple expansion on top of it, and continued growth, and a bigger moat around its monopoly because the Chinese government has regulated all of its competition basically out of business. So very short-term bounce. I put this out yesterday that we were likely to see a bounce in the markets with these oversold readings. We cover our intermediate-term view at the end of the article, but very short-term, Thursday or Friday, we could be in for a bounce off these extreme levels. And let's see, I think we were bouncing, and then Bullard came out with hawkish talk, and maybe the Nasdaq's up. Yeah, the S&P is up, and the Nasdaq's out, so the Dow's a little bit weak. Okay, so now on to the shorter term view for the general market. The AAII bullish percent this week came in at 32%, which is a neutral read. It was down from 37% last week. So there's neither massive euphoria nor massive fear in the market. Goldilocks situation. Same thing with the fear and greed right down the middle at 51. And the National Association of Active Investment Managers actually ticked up to, I think, 88 today I saw. So they've still got more room to chase if this pushes up in the coming weeks. Now, here's some important outlook, and I put a lot of thought into this last night. The next Fed meeting is January 25th to 26th. By then, the only data the Fed will have is likely a decent jobs report from this Friday and limited evidence that inflation is rolling over. As I said in our podcast VideoCast all last year, when people were looking for big crashes, we were not going to get one. We would be limited to a handful of 3 to 5% pullbacks given all the liquidity. That is exactly what we got, by the way, and that was a non-conventional call. This all changes in 2022. I expect to see 8 to 10% plus mini corrections moving forward. If we continue to gain strength in coming weeks, I'm inclined to harvest some profits and build a little cash going into that Fed meeting. Their recent hawkish pivot is not expected to change until inflation rolls over, and I think the earliest signs of that will be in March. February may create some great opportunities to go shopping for those who harvested a little bit of cash. It's not to say go all to cash, binary, risk on, risk off like a retail trader. It's just building a modest amount so you can participate in any dislocation. So for the longer term investors, you'll likely hold on through the air pockets. They haven't inverted the curve yet, so no recession is on the horizon in the near term, just a bit of turbulence short term. Okay, so that was the read. Yeah, it got up to 89.54 for the National Association of Active Investment Managers. Quick economic data, manufacturing PMI a little lower than expected, but not a big difference, 57.7 versus 57.8. Construction spending was up 0.4 versus up 0.6 expected. ISM manufacturing employment, that beat expectations. ISM manufacturing PMI was a little light, 58.7, obviously still an expansion, but below 60 expectations. The prices came down. ISM manufacturing prices were supposed to be 79.5, down from 82.4. They came in at 68.2. This is what we covered before. The JOLTS was less than expected, 10.5 million job openings versus 11. And the API, there was a big drawer, which was confirmed by the EIA on Wednesday, 2.1 million draw. Expected was 3.2 million draw, but it's still showing demand. The ADP non-farm payroll was good, but the jobs data was medium this week. The continuing claims spiked up more than expected. That's the key number that I look at. And the initial jobless claims spiked up a little bit more, but that's natural with the the mania, fear about Omicron in the short term. But, it's interesting. If you look at mobility and tracking data, it's down so much less than the previous variants. People are just ignoring it and getting on with their lives. And I think everyone's like, I might as well just get it because that's going to be the greatest form of immunity. And the vast majority of people who have gotten this variant in my circle, they're down for a day and a half, 2 days, and they're back in action. They feel great. Factory orders were up. So that's basically it for this week. Want to thank you for listening in. Happy New Year. We'll be back next week, same time, same place. In the meantime, make it a great one. Bye for now.